Thank you for joining today's webinar on dedicated managed accounts, taking control of your hedge fund allocations. My name is Amanda Rock, and I'm the Communications and Social Media Manager for the National Conference on Public Employee Retirement Systems. Today's program is part of our Center for Online Learning, which provides remote continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. With public scrutiny of pension systems hedge fund investments seemingly increasing every day, many plans are turning to dedicated managed accounts as a way to help manage costs, increase transparency, and take greater control of their alternative allocations. In today's webinar, we will explore the drivers of this trend, discuss the various types of structures and attendant benefits or drawbacks, and identify the roles and responsibilities of participants. Our presenters today are Ben Laffey and Ryan Lucenta from BNY Mellon. We encourage audience participation. Please submit questions by using the GoToMeetings portal. However, to ensure that we can cover all of our topics, we will hold your questions to the last part of the program. Ben and Brian, I'll turn the webinar over to you.
Thanks very much, Amanda, and thank you to NCPERS and the Center for Online Learning for helping to organize and host today's event. Welcome to those of you on the phone who've joined us today. We're excited to be talking to you today about dedicated managed accounts and taking control of your hedge fund allocations. Just very quickly before we get started, to get a few disclaimers out of the way. First of all, this presentation is not intended to constitute investment advice or recommendation. Please note that investments in hedge funds are speculative. They involve a high degree of risk, and they are not suitable for all investors. And interest in funds are not insured by the FDIC, the SIPC, or any other organization. They will not be deposits in any bank, and they are not guaranteed by any bank, including the Bank of New York Mellon. So with that fun stuff out of the way, onto our agenda. Those two handsome gentlemen over there on the right are your hosts today. So that's me at the top, Ryan Lucente, joined by my colleague, Ben Laffey. Both Ben and I work at Hedge Advisors, which is part of BNY Mellon, involved really in investor education and business development activities. In terms of our agenda for the day today, Ben's going to start us off talking a little bit about some recent headlines and some of the trends in the sort of hedge fund and pension fund investing industry. We'll take some time to talk through some definitions to make sure that we're all sort of on the same page in terms of terminology and what we're talking about and distinguishing between various structures. We'll spend some time looking at why investors are using managed accounts, some of the benefits of the structures and what's been driving some of the change in the way investors are allocating. And finally, we'll wrap up by taking a look at the different roles and responsibilities that the various parties play in these structures. As Amanda mentioned, we will have a Q&A session at the end. Ben and I are going to try to keep our comments to about 40 minutes, maybe a little less, so we should have time for plenty of questions at the end. And please do speak up and let us know what we can help you out with. So with that, I'm going to pass it over to Ben to get us started.
Thanks, Brian. Hopefully, most of you stuck around after you read the disclaimers, but we did make a friend in compliance who wanted us to say that. So it's important stuff. So I think we're going to start by stating the obvious, which is that pension plans are really under the microscope when it comes to investing, more so when it comes to alternatives, and when it comes to hedge funds. Maybe the only thing, at least recently, that's gotten more attention is trying to identify the author of the op-ed article in the Times last week on who's on the inside of the Trump administration. But we all know, all kidding aside, that the media portrays hedge funds in an extremely negative light. They often reference the high fees, the low returns if you're looking at the investable HFRX index, the lack of transparency from hedge funds, and the opaque structures. So what we end up finding is pension plans who have large hedge fund investments are often really put on the defensive with the media and with their boards. And we've seen the press drag a lot of plans through the media in recent years. New York Common was obviously hit pretty hard by a DFS report that was then picked up by the media. New Jersey, with a new governor, has been very vocal about hedge funds. Not a month or two goes by where we don't see Illinois teachers defending their hedge fund portfolio and their returns, and In Kentucky also was another plan that faced a lawsuit and was dragged through the mud. So there has been a lot of attention. I do think though that the scrutiny has had some good effect and some positive has come out of it. One, it's forced plans to go back and reflect why they've invested in hedge funds to begin with, and many have concluded that they do add value and they have low correlation to their other asset classes. They provide diversification benefits. Many of them have identified managers who outperform the benchmarks, and there's a host of other reasons why most plans have stuck with the asset class. But I think more importantly for today's conversation, it's brought their attention and focus on how they've chosen to access hedge funds in the past. And when they went into hedge funds originally, most of them chose to go into a manager-controlled commingled fund. And as they looked at the world today, I think they're recognizing and questioning if that's the right vehicle. In a manager-controlled fund, your investments commingled with a host of investor types: high net worth individuals, wealth management firms, private banks, other smaller endowments, pension plans. But all of those investors have very different types, particularly from that public pension plan. Plans have very different return objectives, different risk profiles, different volatility targets. They're investing a lot larger in size, so should they be paying the same as a high net worth individual? And what we've started to see is over the last couple of years, these larger institutions, the larger public plans who are writing very large checks are coming to the conclusion that maybe they can get more out of their relationship with the manager if they start shifting into dedicated managed accounts. So we'll transition to the next slide and highlight some of the trends in the industry. You can see at the top that there is a pretty big adoption of managed accounts. So we did a survey, BNY Mellon did a survey in conjunction with FT or Mark, and surveyed about 350 large institutional investors. And it came out that 37% are investing in managed accounts in some portion of their portfolio. Of all those investors, that represented a 30% figure in terms of total portion of money that's invested in hedge funds. And if you translate that into real dollars, using a relatively simplistic approach, where you get is about a $300 billion participation rate or percentage of the industry that's invested in managed accounts, taking a $3 trillion industry. And those numbers actually increase even more if you look at some of the recent surveys by the prime brokers. So Credit Suisse also did a survey earlier this year, and they found that 25% of all flows over the last 12 to 18 months were going into dedicated managed accounts. And again, translating that into real numbers, that's looking at more like a $750 billion number. So this is significant and increasing part of the industry. When you start to focus on the reasons why, the reason that's most given was for transparency. And I think we bucket transparency in a couple different ways. The obvious is knowing what the holdings are in the hedge fund portfolio that investor owns, and how that fits into their broader portfolio. So moving to a managed account and getting the position level transparency allows that investor to see how it fits into their broader portfolio and also what that manager owns in that specific fund. But it also goes to a couple different other points. One, with the transparency, you can see where the assets are being held. So where you have to look through into which counterparty has and controls that assets. You can see if you have outsized exposure to one of the counterparties, which is a big concern for a lot of folks to see if they've got counterparty risk. And there's really no way to do that in the commingled fund. And then a third big reason for transparency is around expense transparency. So one of the headlines that I didn't highlight on the previous page was a Towers Watson survey of pensions and trustees, and about 80% of the trustees felt that they didn't have transparency into their total cost of ownership. Once you move towards a managed account, you have that look through, you have that transparency, you know exactly what's being charged to your fund, you have a say what's being charged to the fund, and you have that line item transparency. The second most often reason given for use of managed accounts is the ability to negotiate or amend fees. And we see that pretty substantially. Most, if not all, of our clients are negotiating with the managers and have significant cost savings. And that can come about in a couple different ways. One, it's a simple negotiation off the management and performance fee. It could also be changing the crystallization. So rather than have a performance fee that's paid out annually. Maybe you change it to 2 or 3 years, and also putting in things like hurdle rates, which will lower your fees. And then the third reason that most give is customizing the mandates. And we'll talk more about this later, but some examples are changing the volatility target, using leverage, really accomplishing something that you wouldn't otherwise accomplish by going into the commingled fund. And then lastly, on the trends, what we've seen by the increase in participation from these larger institutions, we've seen a shift in managers' willingness to offer a managed account. So you can see that the numbers are pretty high. 76% or 3 out of every 4 managers are willing to offer a managed account today, and that's meaningful. I think investors are taking a pretty hard line where they're realizing that they get some outside benefits by going down this path. Managers are understanding that they need to evolve or die if they want to continue to raise assets from these larger pension plans, and you see a significant shift. I think if we were to look back about 10 years ago, this number would probably be more like 50% or 1 out of every 2. And when I started Hedgemark about 6 years ago, I think the number one reason why people who were interested in going down this path gave me resistance was they would say that their managers may or may not participate in it or offer a managed account. And those conversations are changing. I think most people find that a good percentage of their managers are willing to participate in a program. So now we're going to shift over back to Brian to talk a little bit more about what a managed account is.
Thanks, Ben. That's great. So now we've had a little bit of a sense of sort of where the industry is growing and how it's been changing. I think it's important that we take a bit of a step back and just sort of define some various structures here to make sure we're all sort of talking about the same thing. As is often the case, the language we use to describe these structures is very important, particularly because the sector is still evolving and there are a number of different models that are out there being used. So the baseline concept of segregating assets away from other investors is something that you'll likely be familiar with from the long-only world, where the use of separately managed accounts has been common for a long time. In this model, the assets are owned and controlled directly by an investor. That's typically done by implementing a custody account to hold assets, where you can employ either a single or multiple third-party managers to direct trading decisions. Works very, very well for funds and portfolios that only hold long-only or fully paid-for assets and that don't really employ any type of derivative or shorting strategies. Things do get a little different when we move into the alternative or hedge fund world, where you've now got multiple trading counterparties, you've got derivative trading agreements, financing agreements, and the like. So we highlight here the concept of the fund of one in the hedge fund world. And the reason we highlight fund of one, although there are some other alternative structures out there as well, is that this is the one that we see most often blurred or sometimes misconstrued alongside a true managed account. The main distinction, as we'll see and talk a little bit more between a fund of one, or one of the main distinctions, I should say, a fund of one and a managed account, is really revolving around who's the sponsor of the fund. So who's controls and who's set up this vehicle. It may seem somewhat trivial, but I think as we see and we go along, it really does make all the difference. So a couple points here on the fund of one. First of all, unlike an SMA, this is a true fund, meaning that there is a legal entity that's been set up to facilitate the movement of capital and to segregate the assets into a limited liability structure. In this case, the fund of one, the legal entity, is controlled and set up and formed by the manager on behalf of a single investor. This is also the entity that will serve as the counterparty for the prime brokerage agreements, for the ISDA agreements, for admin agreements, and the like. Now, while certain terms, including potentially fees and investment, customization of the investment mandate, may be possible in a fund of one model, the important thing to recognize again is that it is the manager, in this case, that sets up and operates the funds. What that means is that the selection and the oversight of the trading counterparties, the service providers, all the cash management, the cash movement, the reporting, the liquidity, etc., these are all typically done and controlled by the manager, as would be the case if you were invested into their commingled vehicle. The only real difference here is that the fund is being managed for a single investor versus multiple investor. So while it does remove the concept of co-investor risk, this doesn't address all the concerns that an investor may have. And lastly, in a fund of one model, given the structure that we just described, Typically, these are only implemented in a single manager model, so not really possible in most cases to have a multi-manager fund of one. So next we move on to the concept of a dedicated managed account. This is what we're going to spend most of our time speaking about today, and this is sort of what we defined as a true managed account. And I think the fundamental concept here is that the legal entity, that is the fund itself, is formed and is governed by the investor and not by the manager. So this is really a fundamental shift in the way we think about running a hedge fund portfolio, and truly does make all the difference. So the concept here is, as opposed to subscribing to a third-party investment vehicle, within the DMA, it's the investor's own fund, it's their own vehicle that they've set up for their own behalf that hires a manager or managers as a trading advisor, and that trading advisor's role is limited solely to trading the portfolio. We're going to go a little bit later on in the presentation. We'll sort of see what it means in terms of implementation and ongoing operations and whatnot. But I think for now, the real key to understanding the power of this model is that by limiting the manager's role just to trading the portfolio, investors are truly able to construct a highly controlled environment for governance and for oversight of their hedge fund portfolios. Obviously, the DMA removes co-investor risk, same as in the fund of one, but beyond that, by removing reliance on the manager's operational infrastructure, it all but eliminates exposure to operational risk, to some potential conflicts of interest, and even to fraud on the part of the managers. Ben's going to take us through in a little more detail on the next slide, but it's important to note that DMAs do not only provide full portfolio transparency and asset control, as we discussed a little bit already, but they also offer a great degree of customization in terms of investment mandate design and in terms of the fee arrangements. So with that, I'm going to pass it over to Ben to talk a little bit about some of the benefits of the managed account model.
Sure, thanks. So there's obviously a host of benefits that you achieve by using managed accounts, and we have them a lot of them up on the screen here. What I've decided to do is walk through a little bit of a case study using a client example. We have a large public pension plan who's a client. I won't give their name for this discussion. I'm happy to talk offline a little bit more specifically, but they are a well-known investor. When they were looking at their hedge fund portfolio about 5 years ago, they had a substantial portfolio, and they wanted to see if they had the best solution in place. They looked at their fees, and they were paying on average 1.8 and 18% incentive fee for their fees, which they just deemed as really ridiculous, and they had to find some program that was going to solve that. They didn't have any real transparency into what their positions were in the hedge funds that they owned, and they saw that as a major flaw because they wanted to see how their hedge fund portfolio fit into their broader asset allocation and their long-only investments. They had some problem historically with some gating, so the board, while behind the concept of increasing their hedge fund portfolio, had come back to them and said, you have to find a solution where you control the assets, and you're not going to run into a situation where we're stuck over a 5-year period trying to get the assets back from the manager. They were a bit frustrated by the manager universe that they were able to invest in, because of the size that they were really left with the largest of the large investors, and they felt that, the largest of the large funds, and they felt that a lot of those funds had high correlation to one another, canceled each other out from a performance perspective, and they wanted to really invest in smaller funds down to the billion or a little higher in terms of asset size. And then they also did a little bit of the expense analysis, and they felt that a lot of the expenses that were being captured and charged to the manager's commingled fund didn't apply to them as an investor, and they wanted to take a little bit of a harder line negotiating away some of those expenses. So for them, they really concluded that their best path forward was to do and set up a managed account program. And they launched that about 4 years ago now. And the results have been very successful for them. In terms of fee negotiation, they've been able to get on average their fees to be about 1 in 12. So 1% on the management fee side and 12 on the incentive fee. And that's by being creative in terms of how they've set up their relationships with the managers through changing the crystallization, also putting in hurdles, straight negotiation on fees, maybe giving a hedge fund a longer lockup in terms of a lower fee structure. But overall, they've been very satisfied with the fee discounts they've gotten. They've taken a very ruthless approach with the hedge funds in terms of what expense could be charged to their funds, and they've left it on average very basic. So only legal costs, the fund admin, and the auditor can be charged to their fund, with some exceptions. They have a total risk solution in place now that they have transparency from the hedge fund manager, and they can see where their exposures are more broadly across their entire plan. And it's given them more comfort in sizing up some of their individual hedge fund positions. So they've really built out a more concentrated portfolio, but put in substantial size to the individual managers where they feel like they can get some alpha and some more return generated from those managers. They have also been able to go down the asset size in terms of which managers they've invested in. So because the managers are no longer doing the non-investment functions, the operations are being done away from the manager. They can really overlook what they couldn't before from an operational due diligence perspective because they have that managed account, and they've been able to invest in managers that they always wanted to but couldn't because of the size and the infrastructure. So it's been it's helped from a return perspective as well. And then they also feel that because they have the managed account, they have more regular communication with the manager. They understand the manager's risks and what they're trying to achieve from an investment perspective. They've had some relationships where they've launched some custom strategies with managers, where a manager will call them, tell them they've got a great trade idea, and the plan has been able to launch a separate fund with a trade idea or with a new strategy of that manager because of the comfort level that they've been able to attain through the managed account. And the results have been really positive for them. They've saved the plan over $100 million in cost savings. It's $50 million annually. If they look at the outperformance of their managed account portfolio versus the legacy commingled portfolio, they're looking at 300 basis points of outperformance through a combination of the lower fees, the different manager types, maybe more emerging managers or guys who can be a bit more aggressive. And it's allowed them to go on the offensive with the media. You really don't see this plan in the media all that much, certainly around their hedge fund portfolio. And if you do, it's around cost savings and some of the other benefits. So that touches on a lot of the things that you see on the slide in terms of the benefits. One point that I didn't talk about and I do want to highlight is the cash efficiency. We do see a lot of folks go down the path of using the dedicated managed accounts because they can notionally fund an investment. So there's certain strategies like CTAs, like some long-short equity strategies, where if you're going to invest in a manager's commingled fund and you want $100 million worth of exposure, you have to write a check for $100 million. But if you're doing it through your own managed account, you're able to post just a portion of that in margin, maybe it's 20 or 30%, and then you as the investor have the excess cash, and you can choose to be maybe more aggressive with that cash or conservative. But the point is that you control that cash and you don't have to fund the manager's vehicle with that. So that's what I wanted to highlight on why investors are doing it. Again, happy to talk more specifically about that one investor or any of these points at a later date.
Great. Thanks, Ben. So, I think a very good discussion there and very illustrative story of, the benefits and kind of why dedicated managed accounts are working, how they're working for some investors. But probably worth spending a little bit of time talking about, okay, this is great, but, how does it really work? We have these conversations with our friends in the public pension space all the time. This sounds fantastic, but, how am I supposed to run a single manager hedge fund platform with my limited staffing and my resources? It's like, I can't even spell ISDA, and now I'm supposed to go out and start negotiating them. I don't know how I'm supposed to do this. I think the important concept here is that the idea of the dedicated managed account model, as we conceive it, is based on, a framework of separation of duties, right? That relies on each party really doing what they do best. So as we walk through this slide here, hopefully we'll get a sense of what that means in practice. So the first thing we're looking at here is a very sort of simplified diagram of a traditional fund structure. You may notice that there's a very important party missing from this simplified structure, which is the prime broker and the trading counterparties. The main reason is because I didn't have enough space on the slide to put them in there, but I think for the purposes of what we're going to discuss today, their role is not substantially different within the traditional fund structure and the DMA structure. But it is important to note, obviously, that they are a significant part of this discussion as well. The same actually could probably be said of the administrator in terms of their official functions and roles not changing much in the two different structures. However, to help differentiate some of the official functions that they perform versus what the hedge fund manager or the other counterparties or the other participants, do, we thought it was important to leave them up there. So if we look a little more closely at some of the roles for each of the parties here, we see within the hedge fund manager vertical, investment functions, which we would expect, but then a whole series really of functions that have nothing to do with investment and really could more properly be categorized as, operational functions. These are things like the fund setup, the cash movements, the reconciliations, operating functions, and so on. That really more related to, sort of running a business and running a fund as opposed to managing a portfolio. Let's have a look at how this changes when we shift over to the concept of a DMA structure. So the first thing that probably pops out is the addition of this extra box here of the platform provider. We'll go into some more detail, obviously, on what that means, but it's sort of the answer to that question of how do you spell ISDA, right? So we mentioned that the functions of the administrator remain essentially the same, right? So we're still talking about a fund structure. We're still talking about a legal entity that was going to require all of the traditional functions of NAV calculation, maintaining official books and records, processing the capital flows. So the administrator role essentially stays the same in the new structure. A big change that we notice next when we look at the hedge fund manager is their role, as we've mentioned several times now, limited just to investment functions. Right, so this is primarily strategy development, this is research, this is portfolio management, this is trading. None of these other operating functions, as we've kind of defined them here, are included. And we think this makes sense because hedge fund managers are being hired or being selected to do what they do best, which is trade a portfolio and hopefully generate meaningful alpha for your fund. Next, we take a look at the impact to the investor. So, clearly, manager selection remains an important role. And you're a fund, you need to be able to pick your managers. No change there. Where we do see the big change is we see the shift in the asset and the cash control over to the investor from the hedge fund manager. And we also see this as the structure enables the investor, as Ben alluded to earlier, to not only have transparency into their service providers, but to actually be able to select both service providers and trading counterparties that may better fit their specific needs. So, who does all that other stuff in those blue boxes that the hedge fund manager used to do? That's where the platform provider concept comes into play. So I think it's important to note that it's really the development of the platform provider that we see as powering this sort of accelerating shift and this increased adoption of the managed account model. It requires, obviously, a significant amount of development and application of resources in terms of not only of people, but of systems and of processes to effectively run a single manager hedge fund. And that's not something that typically our pension fund friends are equipped to manage on their own. This is where a platform manager or a platform provider, comes into play. So just to run kind of quickly through the concept here, it really starts with consultation and implementation of the proper fund structure and the proper governance model for the platform to ensure that it's fit for purpose and that it's obviously meeting all the regulatory requirements. This setup will include negotiating counterparty and service provider agreements, setting up accounts, establishing the data transfers, onboarding of all the counterparties and service providers, and of course, onboarding of the managers themselves. Once the platform funds are set up, the platform provider should also be providing all the ongoing operational oversight to run the fund. So this includes things listed here, such as affecting all the cash movements, monitoring and managing the collateral, providing the shadow accounting, reviewing the gross asset value and net asset values, and all the sort of year-end financial statements and the tax preparation as well. Again, all of the functions that are necessary in order to operate a hedge fund when the manager is no longer performing these functions. Separating that out into a specialist provider is kind of the key concept there. So in addition to taking over some of the operational burden here, we have the addition of a couple more boxes or features that come along with it. Ben's already spent some time talking about the idea of strategy customization and notional funding, which are powered or enabled by the DMA structure. But importantly as well, with the transparency, the platform provider is able to really run what we refer to as portfolio surveillance. That means helping funds to set guidelines at the outset of a relationship and to monitor those on an ongoing basis, and also to provide the risk and the performance reporting in a digestible and a meaningful way to investors. Right? It's one thing to have the data, but making sense of the data is probably more important. I certainly get asked the question all the time. All right, Brian, so we're going to have full transparency. What am I supposed to do with it, right? So the good news is that your platform provider and others out there, have teams of people that are dedicated to helping you make sense of that and to helping you, organize that data in a meaningful manner. I think, what this slide hopefully illustrates is that, the model fundamentally alters the dynamic, right, of who controls the hedge fund program. Again, we've talked about it already, but limiting the hedge fund manager to this role as a trading advisor is a fundamental shift in the way we think about running a platform. And again, it's really enabled by the advent of providers on the platform side. So now that we've convinced all of you that DMAs are the way to go, it's probably important to spend some time thinking about, what are some of the things to consider as you may be thinking through making a change.
Yeah, I think we hit on that. There's definitely some clear benefits to invest using dedicated managed accounts, but there are certainly some key decision points to see if it makes sense for you as an investor. The proverbial joke that nobody ever laughs at of size matters does come into play here. So you can see that allocation size is going to be a meaningful driver to whether this works for you. Typically, we see 75 million as a threshold for somebody, both a manager willing to do it, and from a size perspective of it making sense for an investor to invest in this way. And that's really for a couple of reasons. On the manager side, 75 million is typically a dollar amount that makes it interesting for them to say yes to an investor asking for a managed account. Also, they have to try to replicate their existing strategies. So for most strategies, $75 million is the number that it makes sense for. It could be higher for certain credit funds or other strategies, but 75 on average is really the entry point. And then as you get higher from there, the expenses will go down on that fund. So that's the other consideration from a size perspective. Those things that Brian spoke about on the previous slide, these vehicles do have certain expenses like legal, like audit, like administrator, and you need the fund to be a significant size for those costs to really be an insignificant portion on your vehicle. So size is really the starting point that we'll talk to with folks, understanding their investment size, their portfolio, whether it's going to be growing, and from there we'll talk about how you would actually implement the program.
Sure. So we spent some time on the last slide obviously talking about all the functions that need to be performed here. It's no secret. This is not an easy lift in terms of resources. The staff, the systems, the processes. Hedge fund managers spend a lot of time, certainly the big ones, in building out these capabilities. And typically in the investor world, these are not considerations that come into play. We write a check, we send a check to our manager, and we get our returns and some of our transparency each month. So when you're thinking about trying to implement this type of model, you need to think about what is going to make the most sense in terms of the division of duties and potentially looking to outsource to a platform provider. The good news there, as we've discussed, is there are firms like Hedgemark and others that have come in and developed very meaningful, very useful, and very comprehensive set of services to help facilitate this. I don't think that we would see those numbers that Ben talked about earlier on in the presentation, the 38%, 37% adoption, 30% of the portfolio. Those wouldn't be possible without the providers having stepped up and stepped into this space to help investors, implement these programs, think about these programs, figure out ways to get the most out of these structures. So I think that's probably the two things that we spend the most time talking about. We touched a little bit on the idea of digesting the information that comes out. A good provider should be able to help you with that as well. On the allocation size point, there are and there do exist some other structures and some other platforms out there that actually can help offer many of the same benefits of managed accounts when the investment size is a little bit below the figures we have here, and we can certainly talk offline about access to some of those products as well.
And then just one other point, we really have. I don't think we've ever seen a public plan implement a program on their own. They're really their goal is to focus purely on the investment standpoint, and they're not looking to take on the project of building, operating, and owning a platform. So that's really the job of firms like ourselves to do the heavy lifting and make this as easy on the investor as they would access a manager through a commingled fund.
I think that brings us just about to the end of our prepared remarks. Luckily, we didn't go too long, and we've got plenty of time left over here for some questions. I think we're going to hand it over to Amanda, who's going to let us know how to get that set up.
All right, thank you for your presentation. We do have a few questions. The first one is, can you speak in more detail about what types of managers are willing to offer managed accounts?
Yeah, so thanks for the question, whoever asked that. So what we've seen historically, I think there was the stereotype that only simple strategies rather, like a long-short equity or CTA would offer a managed account. And we've seen that drastically change. So if you look at our platform, for example, we have about 100 managers on the platform, and it runs the gamut of strategies from credit, complex global macro, to long-short equity, CTAs, even some multi-strats. So I think what's happened is when folks like ourselves came on the scene, and we have a pretty large team, 250 people. A lot of our staff worked at hedge funds. We built out systems and processes that could really replicate and support some of these more complex strategies. They found that groups like us they could work with, and any strategy could be done through a managed account. So I think that's something to consider where historically maybe you thought that only limited number of strategies could be in a managed account. You really need to view the world and say, okay, if I have the right dollar amount, I could do any manager or any strategy in a managed account.
I think just to add to Ben's point there as well, as the sort of critical mass of large institutional investors is increasingly using these structures, some of the managers that may in the past have been reluctant to offer managed accounts are sort of changing their tune a little bit. So again, 5 years ago, 1 out of 2 managers was maybe the norm. We see it not just being new managers looking to raise money, desperate for capital, but significant players, household names that are working more closely, becoming more aligned, and using these structures as a way to actually deepen relationships with some of their investors. So just the total universe of managers and some of what was previously called selection bias has significantly changed over time.
Okay. Another question, are there certain strategies which lend themselves more readily to managed account structures?
Yeah, so thank you for that question as well. Maybe a timing thing. I think Ben addressed that somewhat in his previous question. We really see a wide variety of strategies being utilized. There aren't really any strategies that I'd say don't fit into managed account. I mean, I suppose a pure play private equity might not be a good fit for this type of structure, just because of the lack of necessity to outsource the functions. But pretty much any standard hedge fund strategy is a reasonably good fit.
Sorry guys, I had my phone on mute.
Sure.
Who are some of the providers in the outsourced managed account space?
Yes, sure. So we're certainly not the only group that does this, but what we've seen is a lot of our competitors are some of the legacy or older funds of funds who were allocating to managers through managed accounts and built out their business to offer managed account platforms for investors. So there's groups like Man, for example, that do this. But what we've found, and where we're a little bit different from them, is that they link their advisory services to their managed account platform. So a lot of their expertise and a lot of their staffing is really devoted to helping select and research managers. Less of their expertise is on the structuring and operations of the platforms. And they also link their advisory services to the platform. So if you ever wanted to maybe pick a different advisor or unwind that relationship, you have to unwind your platform. Where with us, it's really controlled by the end investor, and hopefully they don't ever want to fire us. But if they chose to find a different platform provider, they own and control that platform, and they don't have to unwind that platform.
Yeah, I think maybe just to add to that, what we find in some cases too, this goes back a little bit to our discussion around the fund of one versus the true managed account, is that some of the other providers don't perform all of the functions in terms, particularly around cash and collateral processing that others do. So there are firms that are pure play infrastructure providers. Ourselves is a firm up in Canada called InnoCap as well, that does something similar, slightly different model than some of the investment managers that Ben alluded to.
Okay, and our final question is, how do I approach managers to begin a discussion over changing fees, structure, terms via a managed account?
Sure. So this is it's a great question. So this is one that we hear pretty often, right? So the dynamic in the industry for a long time, frankly, has been that the managers are the stars and they kind of call the shots. And if I go to my manager and I say, hey, I'm thinking about doing a managed account, he's going to sort of turn around and say, well, good luck to you. I think aside from the commentary we've already made around the changing attitudes of the managers, what we found is that these conversations tend to work best in a context where an executive decision has been made internally, by the investors that we're going to move forward with this model. They look at their managers and they say, okay, are we going to consolidate, or how are we going to reallocate? Are we really getting the most out of what we currently have? So the conversations they have with the managers cannot just be, put me in a managed account or I'm pulling the cash from you. And many times it's actually, we're going to upsize our allocation with you. But in order to upsize the allocation with you, we're going to need to do that through a new structure and in a new way that's a little bit more beneficial to us from a control perspective. So I think part of it is maybe squashing this myth that it has to be a confrontation with a manager, and it becomes much more of an involved conversation. We ourselves get very involved in those conversations early to make sure that the hedge fund managers, if they don't already work with us, understand the role that the platform provider plays, so they get comfortable with shifting some of the responsibility away from their own internal teams. I think that's an important part of it as well. Also what we see is that it's not an all or nothing proposition, right? So it's not the case that we typically see where an existing hedge fund program that already has 50 managers and a few $1 billion in assets in it overnight becomes 100% managed accounts, and that's it. What we typically see is it starts with 1 or 2 mandates or 3 or 4 mandates, and over time, as the benefits of the structure and as the teams get used to allocating to and using these types of structures, the assets in the managed account side grow as perhaps the commingled side of it diminishes. So I think the approach is not is something to consider, but I would warn people off of any sense of nervousness or apprehension about having these discussions, mainly because the managers have heard it before, but also because if you stick to your guns and you follow through with it, it's going to work out in your favor in the end.
Okay, so those are all of our questions. Do you guys have any final thoughts you want to share with the audience?
No, we really appreciate, obviously, NCPERS for hosting us. Brian and I do a lot of education in the space, and we encourage you to reach out to us directly. I guess the contact details will come from you, Amanda, should they need it. Will you send out that post-call?
I can, of course.
Yeah, it's part of the presentation as well. So I believe there may be a replay that will be coming up that NCPERS will put up on their channel. So that's another way. But absolutely, please reach out. Feel free to let us know how we can help. And thank you again for your time.
All right, well, thank you. And that concludes our webinar. At the conclusion of this webinar, there will be 3 short survey questions that we ask everyone to answer. And we look forward to seeing you at the next one. Bye.
Thank you.